So investment in associate becomes our next topic. So investment ownership of between 20 to 50% is usually considered influential. Influential investment are accounted using equity method. And under the equity method, the initial investment is recorded at a cost reported on a balance sheet as a non-current asset. In subsequent period, the proportionate share of investees' earning increases the investment account on the investor's balance sheet as recognized in investor's income statement. Dividend received from investee are treated as return on capital and thus reduce the investee's account. Unlike investment in financial assets, dividend received from investee are not recognized in investor's income statement. If the investee reports a loss, investor's proportionate share of loss reduces the investment account and also lowers earning in the investment income statement. If the investee losses reduce the investment account to zero, the investor usually discontinues the use of equity method. The equity is resumed once the proportionate share of investee's earning exceeds the share of loss that were not recognized during the suspension period. Unlike financial asset, the investment account is not reported at fair value. However, for the fiscal year beginning November 15, 2007, equity method investment can make an irrevocable election to report the investment on balance sheet at fair value. In this case, changes in fair value are recognized in the investment's income. Although equity income, the proportionate share of investments earning is reported at investor's income statement, it is usually excluded from operating income. So that is, we'll add another part and add to that. So excess of purchase over book value acquired. Rarely does the price paid for investments equal proportionate book value of the investor's net asset, since the book value of many assets is based on historical costs. At the acquisition, the excess purchase over the proportionate share of the investee is allocated to investments identifiable assets based on their fair value. Any remainder is considered at goodwill. So just remember here there are three things here: book value, fair value, and excess of fair value. So excess of fair value is the goodwill and not the other part. So don't think like anything paid over the book value is the fair value. So the fair value that you have above the value that you can identify from the market. So if you buy a stock, the market price is its fair value. Anything paid above the market price of that stock is goodwill. In subsequent period, the investor recognizes expenses based on excess amounts assigned to investees' assets and liabilities. The expense is recognized consistent with investees' recognition of expenses. For example, the investor might recognize additional depreciation as a result of fair value allocation of the purchase price to the investee's fixed account. So we might be required to fix that as well. It is important to note that purchase price allocation to investees' assets and liabilities is included in investors' balance sheet, not the investees. In addition, the additional expenses that result from assigned amount is not recognized in investees' income statement. Under the equity method of accounting, the investor must adjust its balance sheet investment account and the proportionate share of income reported from investees for this additional expense. Under the equity method, the investor do not actually report separate assets and liabilities of the investment. Rather, the investor reports the investment in one line item in balance sheet. This one line investment account includes proportionate share of the assets, net asset at fair value, and the goodwill. The next part become impairment of investment in associates. Equity method must be tested for impairment if the fair value of the investment falls below the carrying value investment account on the balance sheet and the decline is considerable permanent. The investment is written down to fair value and a loss is recognized on the income statement. If there is recovery in the value in the future, the asset cannot be written off. Transaction with investees. So far, our discussion has ignored transaction between investor and investee because of its ownership interest. The investor may be able to influence transaction with the investee, thus profit from the transaction must be deferred until profit is confirmed through sale to a third party. Transaction can be described as upstream, investee to investor, or downstream, investor to investee. In an upstream sale, the investor has recognized all profit in the income statement. However, for profit that is unconfirmed, goods have not been sold to the investor must eliminate its proportional share of profit from equity income of the investee. For example, investor owns 30% of the investee during the financial year. Investee sold goods. Investor has recognized 15% of profit for the sale. At the year end, half of the good purchased from investee remained in investor's inventory. All of the profit is included in investee's net income. Investor must reduce its equity income of investee by investor's proportionate share of the unconfirmed profit. Since half of the good remains, half of the good is unconfirmed, the investee must reduce the equity income by 50%, which is unconfirmed, into 30% or whatever the ownership you have there. Once the inventory is sold out, then you can actually bring them to your accounts. In a downstream sale, the investor has recognized all profit in its income statement. Like the upstream, investor must eliminate the proportionate sale of profit that is confirmed. For example, investors own 30% of investee during the year. Investment sold 40,000 of goods to investee 50,000. 90% of goods were sold by the end of the year. In this case, investee profit, whatever the profit was, say suppose 10,000, 5,000 and 40,000. Investees has sold 90% of the goods. Thus 10% of the profit remains invested. Investors must reduce the equity income by proportionate share of the unconfirmed profit of whatever they have got, profit into unconfirmed amount into 30% of ownership. So once the investee has the remaining inventory, you can then recognize the full profit. Analytical issue for investment in associates, and then we have got business combination. So we are still into the equity method. When investee is profitable, its dividend payout ratio is less than 100%. The equity method usually returns a higher earning as compared to accounting methods used for minority passive interest. Thus, the analyst should consider if the equity method is appropriate for the investor. For example, investor could use the equity method in order to report the proportionate share of the investee earning and when it cannot actually influence the investee. Also, the investee's individual assets and liabilities are not reported on investor's balance sheet. The investor simply reports its proportionate share of investee's equity in one line of the balance sheet. By ignoring the investee's debt, the leverage is lower. In addition, the margin ratio are higher since the investee revenues are ignored. Finally, the proportionate share of the investee's earnings are recognized in investor's income statement, but earning may not be available to investee in form of cash dividends. That is, investee's earning may not be permanently reinvested. So that is like investment associate. Then we have the business combination. Now there are different types of business combination and there could be many names to that. So under IFRS, business combination are not differentiated based on structure of surviving entity. The US GAAP business combination is recognized as merger, acquisition, consolidation or special purpose entities. Historically, two accounting methods has given use of business combination, the purchase method and the pooling of interest method. However, over the last few years, the pooling has been eliminated. Now we have the acquisition method which replaces the purchase method. Pooling of interest method usually use uniting interest method under IFRS. Combine the combined interest of two firms. Use the participants as equal. Neither firm the acquire the other. The assets and liabilities of two firms were simply combined. Key attributes of the pooling interest method. The assets and liabilities of two firms were simply combined. Key attributes of pooling method included like two firms are combined using historical book value. Operating results for prior period are restated through firms are always combined. Ownership, interest continues. The firm accounting basis are eliminated. Note the fair values played no role in accounting for a business combination using pooling method. The actual price paid was suppressed from the balance sheet and income statement. Analysts should be aware that transaction reported under pooling method prior to 2000 will be reported by that method. Under the acquisition method, all of the asset and liabilities and expenses so under the acquisition method, all of the assets, liabilities, revenues and the expenses of the subsidiaries are combined with parent. Intercompany transactions are excluded. In the case where parent owns less than 100% of the subsidiary, it is necessary to create a non-controlling interest, minority interest for proportionate share of subsidiary. Net assets are not allowed in the present. So I will talk about the examples in some other video, but most of this would be now the examples on how we are going to calculate the goodwill and all of them and the joint venture. So I guess that would be it till here. Thank you for listening.